A downgrade by Fitch and the markets flinch. The U.S. government's credit rating has been downgraded, cutting the rating from a AAA, a notch lower, AA+, noting a steady deterioration in governance over the last 20 years. Now, this just leaves 10 countries who have 2 of 3 of their government ratings at AAA standing. Canada is among that group. Now, of course, on the back of this debt downgrade in the United States, there's 2 questions. Why and so what? Let's get some answers from Charles Myers, chairman and founder of Signum Global, whose job it is to translate what's going on politically and what it means for investors. The debt downgrade, perhaps, Charles, should not be a surprise because Fitch had warned that this could be a possibility.
Exactly. Back in May, they did actually lower their outlook on the country, which is typically a precursor for a downgrade. And Fitch, to their credit, have been warning repeatedly in their research notes and their updates that they are deeply concerned about the fiscal mismanagement of the country, both around the debt ceiling and the budgeting process.
And yet we are seeing the markets, as I said, flinch, not to the same extremes we saw back in 2011. How are you thinking through the ripple effects?
So I'd say in the short term, there may be a sort of small risk-off move. We are seeing it this morning in some of the risk assets, especially in the U.S. equity market. But medium term, again, the country is still, investment grade rated. I'd be very concerned if Moody's were to follow suit and also downgrade the sovereign, because then you've got all 3 rating agencies that will have done it. I think that could produce a bigger risk-off move. Again, we have no indication Moody's intends to do that. But overall, I don't see this changing investors' perception of the market or of the U.S. As an investment destination. I think it really just, again, highlights our political dysfunction around some really key issues. And secondly, very importantly, the overall indebtedness of the country and our fiscal outlook, meaning the deficit is only getting larger and will become a problem medium to long term.
And that's where an analyst at Rabobank pointed out is where we could see the impact of the Fitch downgrade is the political ramifications and what that means for, things like the U.S. dollar versus the downgrade per se. Do you share that assessment?
I do. I think, again, in the short term, the Republicans in the opposition, will try to score some political points with the downgrade. And that's fair game. I think the Biden administration's come out very quickly this morning, including Secretary Yellen, to say that the timing is odd and they disagree with it. But I do think, in the end, the average voter in the United States, while the issue of fiscal responsibility resonates with the average voter, it's not typically a major issue in our elections. And so I do think it's a medium to long-term fundamental problem for the U.S. I don't know if it's necessarily going to play out or have much influence, in the election. We'll see. The election's a year and 4 months away.
Well, seems like it's imminent based on how your election cycles go. It's very different from what we see in Canada. But to that point, you had Janet Yellen, Treasury Secretary in the U.S., and other officials call this sort of bizarre and highlighting, economic growth, inflation is down, jobs remain robust, and yet we are seeing, sentiment, approval ratings are not necessarily reflective of that. Can you explain that dissonance?
Yeah, look, I think the economy is strong. I think the labor market is particularly strong. We got some more data on that again this morning. And so, I think what the Biden administration is questioning is the timing of this downgrade, meaning they, some of the Fitch downgrade is based on historical data or backward-looking data. And in fact, where we are today, the economy is actually quite strong and robust. I think that's the case that the administration is trying to make. The truth, though, is what Fitch is really warning about is the medium to long term. And I think they're absolutely right. Really having debt ceiling standoffs and getting close to default. And we will have a government shutdown very likely in October around the budgeting process. Again, that's not the way to manage the world's largest economy. And I do think that some of the sentiment indicators today are reflecting the strong economy, but not necessarily some of the fiscal concerns that we will all be dealing with in the medium to long term.
How long do you think that shutdown could be? How acrimonious? And do you think that's high enough up on investors' worry list right now?
I'd say it's off the radar of almost every investor right now, partly because it's August, and and Congress is out of session; they're on recess. So it'll become very much in focus in September when Congress is back. And the reason I think that the shutdown, we think it's very likely. I would give it a 90-95% probability we go into shutdown in October. The main reason is that the Freedom Caucus in the House are very upset with Speaker McCarthy because they feel that he sold them out in the debt ceiling negotiation a few months ago, and they intend to act out through the budgeting process. The main way they do that is force a government shutdown. To answer your question, I think it'll probably be 3 to 4 weeks long. The markets historically only start to get concerned if a shutdown is a month or longer. This one I think could be a bit tricky, so I am concerned about it, and it will start to come into focus for investors in September.